Hello everyone, how's it going? In today's video, we're going to be talking about Hyliion. Actually, we're going to be updating on Hyliion, about what's the latest and what to do with it. So, Hyliion was a very popular EV stock company back in 2020. And the reason why it was popular was because, of course, back then, the entire market was overheating before the massive sell-off that we've seen over the next 2 years. But also because Hyliion, of all companies, occupies a place that's relatively niche, at least at the time. It occupied the place of EV trucks, or that's like the clientele that it was aiming at. This was a relatively untapped niche, and even today, I would say, it's still relatively untapped compared to other kinds of electric vehicles. So, because of this, the clientele is also actually different, as I've mentioned in my first video when I covered Hyliion. This is a relatively double-edged sword because at the same time it's like, untapped and everything, but also it's a different clientele. It's fundamentally different. It's not exactly the same kind of demands. If you're talking about retail clients, they may look at the brand, they may look at the paint, they may look at, how charismatic the company CEO is, and they may decide to buy it. But when you're talking about trucks, they need to look at numbers. They need to look at whether this makes a positive impact and a significant positive impact on their bottom line, because they're no longer looked as products. They're more looked as investments for additional revenue and less expenses. So because of this, like Hyliion from the get-go needed to prove to a different crowd that yes, they're relevant. Yes, they should go with like their own products. So they have two lines of options. The first one is an add-on. The second one is, full-on EV trucks. So regarding the add-ons, they look promising not only on paper, because I've seen a few reviews about this add-on, and how can I put this? It's like people were not unhappy about it. You see what I mean? I didn't see any spectacular oil savings from the reviews, but what I did see was that clearly people think that this is an interesting tool, right? It's an interesting tool. They feel that this vehicle is lighter, it's more economic on fuel, and so on. And even though I haven't seen like specific numbers suggesting that there are savings, things are at least not looking bad, if you know what I mean. In fact, Hyliion was one of the few companies from that era that hasn't been impacted by some kind of scandal, whether it's the reliability of their data or it's the existence of their products, right? So of course I'm talking about, Nikola. That wasn't too bright, but we may have to do an update for NKLA in the future, because it's interesting to look at like a comparison of those two to see how well or how poorly they have been doing ever since. So yeah, truly, I would say that fundamentally speaking, Hyliion does have interesting products, and they were thinking at the right places. Like, they did think that fuel consumption is going to be a huge issue for the industry. Case in point here, like, I'm pretty sure that now, the reason why a lot of countries are having a lot of inflations is partially because of this, okay? Because the transportation increased, everything else increased along. So if everything's so great, why isn't it doing so great on the financial market? For that, I would say that, first of all, I think that the volume and adoption rate have been an issue for Hyliion. It is true that when people have invested, hundreds of thousands of dollars in a truck, they usually don't want to mess with it. And also because I think that this might be one of the mentalities of some truckers. So they know how the old system used to work, or still works. They know that they can, at least add this amount of money back to the products that they're shipping, or they know that there are rooms that they can wiggle through. But if you tell them that they now need to put on like an additional expense for something that they've never used before, there might be some resistance here and there. So I'm not sure what is the best approach here. If it's me, I would maybe try to reach a few truck drivers and to tell them if they want to try the add-on. So if they don't want to do this, I think that adoption is going to continue to cause them some issues, especially in the stock market as we go forward. Also, is it just because of its financial results? I'm pretty sure that that's not the case. And I also believe that in terms of how much does it matter, it doesn't matter that much, okay? Generally speaking, as far as growth stocks go, what matters is the amount of money that's willing to be put in a sector or in a kind of investments. In this case, in terms of sector, we're talking about EVs, and in terms of like the category of securities is the growth stocks. So if companies don't want to put in more money into growth stocks, or if investors don't want to risk their money in this current time, then it's kind of pointless for them to have good fundamentals, not to mention that they don't. Okay, I'm not saying that it's helping them. It's not. That's not my point. But what I'm saying is, what probably influences its price action the most is the overall market dynamics. Right now, people are thinking about preserving their own capital. They're not thinking about how much money I can potentially make. Of course, it wouldn't hurt, but I can also make, 5 to 6% in bonds. I can also make 5 to 6% in savings accounts, right? If anything, if I have a mortgage and it's going to be renewed in those years, it might be, 6 or 7%. So I have plenty of options to either make money or to make savings, right? If I invest, well, that's not really an investment, but if I pay my mortgage off by $10,000, de facto, I'm making a savings of 6 to 7% of interest down the line. And this one also compounds with what happens afterwards. So yeah, with all these conditions in mind, I would say that it's really not surprising to see Hyliion where it is right now. The price action also gave us an impression that it's going to bottom very soon. So the last time I looked at it, it was a few months ago. And at the time, they were able to bottom and also go up. But then the sell-off kind of continued as autumn kicked in. So really, at this point, we do need to see more support before we want to get in Hyliion. This may not happen in the immediate or even the short term. And typically, the support at this point does need to last for more than a couple of months. So this is the first thing. Second thing is the overall condition. My feeling is Hyliion is probably not going to get higher if there is no additional optimism about things. And we're probably not going to see this very soon, okay? The recession is, first of all, long overdue in people's mind. And also, the EV sector sometimes feels like the fintech. Meaning, it's been here for a while now, and it starts to mature in people's mind. So, a few years ago, people can still say, well, you know what? Now the question is not, how's the fundamental going to look like in a few years? In other words, the numbers of deliveries, the profit margins, and so on, but how cool the company is, and also how to speculate on the speculations. These were the criterias back then, because when the stock was going from $10 to $20 to $50, does it really matter that the company isn't really making any sort of significant deliveries? I don't think so. And I don't think that it mattered to people back then. now that we're in a different market condition, even going forward, like even if we go beyond the current recession period, which is probably going to be at least a few years from now, people will no longer just say, I will pull in money because I think that this company looks great, or I think that this company is the future. No, they want to see that this company proves that it is the future by having a lot of deliveries or having a lot of reservations, or at least by having some more tangible products. There's another company called Lucid that I've covered on this channel as well. Well, Lucid was able to roll out actual models. This is quite huge for a company. So I'm not saying that Hyliion is not. They are working towards it. However, whether they can do it in a relatively short period of time, or if they can do it before time runs out, that's going to be an issue. Because we also have to remember that right now, if this company is incurring loss after loss after loss, it also means that their cash reserves are going to dwindle over time, right? There will come a time when they either have to raise more capital from equity, so that's going to dilute the shareholders, or they're going to have to put on more debt. So these elements all suggest that going forward, investors are going to pay more attention about those things. And we always have to remember that EV is a relatively special kind of sector where people consider them as technology companies. They are valued like they are technology companies. Some other companies try to like frame them as such, but failed. A typical example would be WeWork. You know, WeWork is a is a real estate company. But they try to say that, oh, because we make people work in a different environment, because we stimulate them with the painting on our wall, that should fly because it did work with SoftBank. You know what I mean? Well, it worked with SoftBank, and that's it. Like nobody else bought it. But somehow, collectively, we've decided to say that the EV sector is not cars. They're making technology. You know, they are Silicon Valley. This is why they get a multiplier that's much higher in the market cap. Anyway, so this is, at this point, ancient history. I think the jury's out on this, at least for over the past 10 years. But we also have to remember that if one day valuations start to plummet across the board, including for like crown jewels like Tesla, we shouldn't be surprised. We really shouldn't. Because if people start to say, hey, wait a second, those companies, they make cars. You see what I mean? Yeah, the technology is great and all, but many other companies have it. Like, if we reach that kind of dynamics, there is a possibility that no matter how well Hyliion can be, okay, no matter how great they can do for themselves, if the valuation, like the collective psyche about the valuation changes, it's not going to end up too well. And so, given all this, what is my recommendation for Hyliion? Well, I would say that now is not a good time to buy it, and that it's better to wait around and to see whether the market conditions have changed. And if it's been like a few weeks or even a couple of months that Hyliion has been going up. So that's going to be very important to look at, because I don't really care if I missed the bottom. I just don't want to be caught up with it. Okay? There have been people saying that, oh, you know what? I think that now is the bottom. And where was the bottom? Around $8 to $10. And they went like all in. But you see, it's obviously not the case, right? And at the time, I was like, you know what? The support level is not now. So regardless, I'm not going to get in I've been waiting for the support ever since, I would say, late 2020, and it still hasn't occurred. Okay, it's a little bit like PaySafe. I've been waiting for PaySafe to bottom since the day they went public. They still haven't. So this is why we really have to be patient in a market condition like this, because I do believe that we will be able to get better prices for our investments if we just wait. Okay? Try to quash this fear for missing out, FOMO. You know what? You're not going to miss out. Like, even if you miss out by a couple of months, a couple points of, or a dozen points of percentages, it's not going to matter in the grand scheme of things. Losing 80% because, the person did not decide to DCA in, that's a big deal in my mind. Oh, and also, an allocation for a company like Hyliion, I would say that at all times, it should be between 1 to 3% of your investments. I would say that a company like Tesla should be 5 to 8%. Okay, so that, just to put things into perspective, so that nothing, how can I put it? So that nothing can tip off the balance of your portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.